Consumers, investors, and economists alike aren't just worried about inflation this year, but also that growth could slow and unemployment could climb along with it. So together, worry, slow growth, and rising unemployment could combine to form a major economic supervillain that hasn't been an issue since the 80s. It's something worse than inflation. I'm speaking of stagflation. So I've got what you need to know about it, including what's causing it and how you can survive it. You ready? Let's go. Hi, I'm Matt Theriault, CEO of Epic Real Estate, where we show people how to escape the daily grind so they can retire early. Now, former Fed Chair Ben Bernanke said in a recent interview that the economy could face stagflation this year as prices rise at the fastest pace in 4 decades and the Federal Reserve ramps up plans to aggressively hike interest rates. So some are starting to feel the pinch already. Now, what is stagflation? Well, stagflation happens when growth slows, demand falters, unemployment rises, and almost contradictorily, inflation keeps rising too. And that's so out of the ordinary because unemployment doesn't typically bode well for growth. And when demand takes a nosedive, so can inflation. Businesses likely push back investments. Consumers are either spending less or have limited amounts of money to fund their purchases. And such concepts are at the heart of the popular theory known as the Phillips curve, which suggests that as unemployment falls, inflation should rise and vice versa, but not in a stagflationary environment. Joblessness and inflation were both on the rise at similar points throughout the 70s and 80s. The last time that we dealt with stagflation. So on a chart, their peaks and valleys often follow the same progression. In May 1975, joblessness peaked at 9%. Just 6 months earlier, price increases peaked at 12.2%. Both would remain elevated until the early 80s, when the Federal Reserve essentially manufactured a recession and intervened by raising interest rates. And right now, we could be facing a similar period of time where incomes are not growing as fast as prices. Spending patterns dramatically slow down, businesses stop investing, and all the while, inflation continues to climb. So what causes this? Well, there are very specific ingredients that go into this disastrous cocktail. And a prominent one likely sounds familiar given what's happened in light of the pandemic and Russia's invasion of Ukraine: supply shock. At their basic nature, supply disruptions are stagflationary. For example, if a fast-spreading strain of the bird flu affects a substantial portion of the chicken population, that shortage could raise prices on eggs and meat just as much as it could reduce production and employment. And that's been the case with today's semiconductor chip shortages, which have pushed up car prices because they've limited production. And we saw supply shock in the 70s when an oil shortage prompted an embargo abroad, causing prices to nearly quadruple. What's more dangerous about those kinds of spikes is that they can go on to affect other products and services in the economy. When oil is more expensive, it not only becomes costlier to heat up homes or fill up cars, goods and services that require a lot of energy can also get more expensive. Supermarkets can pass along higher shipping costs. Uber can add gasoline surcharges, of which we're actually seeing right now, all chalked up to the nature of inflation. But high inflation alone isn't enough to cause stagflation. And a large part of why that is because price pressure, left to their own devices, can often be self-correcting. They can inspire consumers to pull back on purchases naturally. And that's where other forces come into play to create this perfect storm, one of which is price instability and another, worry and concern. Even if inflation is high, businesses might be able to better strategize how to eat those costs if they know where they were heading. If inflation jumps around, however, that planning can become very challenging. And making matters worse, consumers and businesses, they notice when inflation is unstable. And it happens to be the number one issue for voters at this very moment. The people have noticed. They're feeling it. And the longer that they do, the bigger the risk that they see it as a facet of American life, of which can make it a self-fulfilling prophecy. Now, an important intermediary is the Federal Reserve. By acting tough with monetary policy and committing to cooling inflation, officials can extinguish the flame before it becomes this raging inferno. But Fed historians argue the Fed wasn't tough enough in the 70s and 80s, and that their loose monetary policy contributed to the high inflation levels of the era. Well, that was then. Is the Fed doing enough right now? Is stagflation going to happen? Now, the Fed's hawkish pivot will be key to keeping history from repeating itself. And Fed Chair Jerome Powell is talking tough, saying recently that there won't be any hesitation to keep hiking interest rates until inflation falls. And to that point, his words alone are having an impact on financial conditions. The 10-year Treasury yield so far this year is up 2.36 percentage points from its all-time low in August of 2020. And mortgage rates, they've followed suit, with the average rate on a 30-year fixed mortgage rising to a 13-year high in May. Now, the stagflation deniers, they cite the unemployment numbers of just 3.6%, near a half-century low. So that would be contradictory to a stagflationary environment with unemployment so low. But are the official numbers a real depiction of the job market? Currently there are more than 11 million job openings and not enough people looking for work to fill them, of which would suggest stagflation unlikely. But the large number of people that voluntarily left the job force over the last year could have the same impact of those that are involuntarily unemployed. Fewer people are in the workforce, and it might not matter much for stagflation as to why they aren't. Now, the rising pressures of a tightening economy could cause labor to return to the workforce, thereby mitigating much of our concerns about stagflation. So let's hope for that. But many have long forecasted that the financial system would hit a fiscal cliff this year anyway, as the economy's stimulus-driven sugar high wears off. Now, growth in the first 3 months of this year also contracted 1.4%, and experts have attributed the decline to trade deficits. And all of that sets the financial system up on an unfortunate reality, one where growth was already set to slow drastically long before officials started taking their feet off the gas pedal. The S&P 500 approached bear market territory during recent trading, meaning the index plunged nearly 20% from its record high, largely on recession fears as inflation rises and the Fed moves forward with rate tightening. Now, it feels premature to say we will definitely be there, but it might be the right mindset for the next 12 months or so, as we're likely to see slower economic growth and inflation isn't going to come down overnight. So what is there to do? Well, whether or not the experts want to declare officially stagflation, that debate might not make a difference to your bottom line. So a little preparation in protecting your money can go a long way. So first thing, take advantage of today's strong job market while you still can. Even with the prospect of growth slowing, businesses still have a historic amount of demand for workers. So take advantage of that power by negotiating for a raise or hunting for a new position. Number 2, make a budget. Now, I'm not a big fan of budgets because they're really difficult to stick to. But high inflation makes it all the more crucial to evaluate where your money is going each month. So take a careful look at your discretionary spending at least. Eliminate what's not necessary and then look for cheaper options on what is necessary. Number 3, plan for emergencies. Use that freed up cash to start adding to an emergency fund. It's not a bad idea really to always have 6 months of expenses stashed away somewhere anyway. Even small contributions to an emergency fund can add up fast and make a really big difference. And take it a step further and just automate it, set it and forget it. And number 4, think about your bear market investing strategy. No investor likes to stomach losses, especially if that money is going toward your retirement or a long-term goal. But in times of severe market volatility, it's important to avoid overreacting. So avoid the urge to sell it off. You may want to diversify your investments a little, but don't sell it off. And remember that the average bear market lasts around 15 months. Yeah, Matt, but this time it's different. That's the popular sentiment every time the economy struggles. Understand that this too shall pass. It always does, and the best is yet to come. So what are your thoughts? Is stagflation likely or not? Let me know in the comments below. And who else do you know that needs to see this? When their name comes to mind, please share it with them. Oh, and if you're already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.